Welcome to the Trading Chaos Beginner tutorial. Today, we'll be exploring concepts based on the work of Bill Williams, a renowned trader and author known for his unique approach to understanding market behavior. This session is designed to help you grasp the fundamental ideas and strategies that Bill Williams introduced, setting a strong foundation for your trading journey. Let's dive in and start building your knowledge in a way that's both practical and insightful. Bill Williams is a legendary trader and innovator who founded the Profittunity Trading Group and developed the unique chaos trading methodology. He's well known for his influential books, Trading Chaos and New Trading Dimensions, which remain foundational in the trading community. Among his major contributions are his creation of iconic technical indicators like the Alligator, the Awesome Oscillator, the Accelerator Oscillator, and Fractals. What truly sets Bill Williams apart is his emphasis on combining these technical tools with psychological mastery. He believed that understanding market psychology is just as important as technical analysis, especially in today's highly volatile markets such as NIFTY and SENSEX options. His work revolutionized trading by integrating chaos theory into practical strategies, providing traders with a mindset and toolkit that remain crucial for navigating complex market conditions. When we talk about the core philosophy behind trading, it's important to understand that markets are alive and not simply linear or predictable. No model, no matter how sophisticated, can reliably forecast market prices all the time. The first step as a trader is accepting this uncertainty, embracing that markets are complex and constantly changing. Chaos theory helps us see that markets are not random, but follow complex, structured patterns. These patterns are nonlinear and fractal, meaning that while price movements might look unpredictable on the surface, there is an underlying hidden order and repeating patterns that reflect market behavior. As traders, our real edge comes from reading the market's real-time structure and momentum. Instead of trying to guess exact price movements, we focus on responding with discipline to what the market is actually doing. Success depends on managing risk carefully and timing our trades based on the market's evolving conditions, not on predictions. To sum up, markets can't be fully predicted, chaos isn't randomness, and the best approach is to react thoughtfully rather than attempting to forecast the future. This mindset is key to navigating market complexity effectively. Trading is tough, and the reality is that most traders fail because of common patterns that are often overlooked. One major issue is analysis paralysis, when traders get overwhelmed by too much data, leading to indecision and conflicting signals that freeze their actions. Emotional trading is another big culprit. Fear and greed frequently cause traders to enter too late, exit too early, or stubbornly hold onto losing positions. Then there's the lack of risk management. Ignoring stop losses and improper position sizing essentially turns trading into gambling. Another mistake is the prediction mindset, where traders become overconfident in forecasting future moves, which often results in stubborn losses and poor decision-making. Overtrading is also common, especially in volatile markets, where chasing every price movement increases costs and lowers the quality of trades. Statistically, over 85 to 90% of retail derivatives traders in India lose money consistently, according to SEBI studies. Emotional errors and a lack of discipline stand out as the primary reasons for these failures. Most traders don't have a well-structured plan and fail to manage risk properly. Successful trading is about accepting uncertainty and focusing on the process rather than trying to predict every move perfectly. To survive and grow steadily, traders must learn to manage losses and avoid impulsive trades driven by emotion. This psychological discipline is at the heart of becoming a consistent trader. When we talk about market chaos, it's important to understand that small events can have huge impacts. For example, a single large trade or a surprising geopolitical headline can set off significant price swings. This is often called the butterfly effect, where tiny factors can ripple out and dramatically shape the market's direction in unpredictable ways. Another key point is that market price patterns tend to repeat themselves across different time frames, whether we're looking at minutes or months. This repetition is known as fractal geometry. Bill Williams cleverly incorporated this idea into his trading indicators, which helps traders recognize similar structures, no matter the scale they're analyzing. Finally, let's not forget the core of it all: human emotions. Every price movement reflects countless decisions driven by feelings like fear, greed, hope, and panic. These emotions generate the waves and momentum behind market trends, as well as the sudden reversals we often see. In essence, markets are nonlinear systems fueled by human psychology, making their behavior complex but also fascinating to study. When we say the market is always right, we mean that price action is the ultimate truth in trading. No matter what analysis or forecasts suggest, the market's movements are the real indicators of what's happening. If a trade moves against you, it's the market giving you feedback. It's essential to adapt instead of resisting. Accepting the market's reality quickly can reduce both emotional stress and financial losses. For traders focusing on NIFTY, this philosophy translates into practical steps. If NIFTY breaks through key support or resistance levels, it's crucial to exit trades without trying to justify losses. Always trust the clear trends you see on the charts rather than personal opinions. Tools like the Alligator and Fractals indicators can help confirm market direction and optimal entry points objectively, making your decisions more disciplined and less emotional. When it comes to trading, many beginners fall into what I call the prediction trap. They try to predict exactly where the market will go using news, tips, or just their gut feelings. This approach treats trading like a kind of prophecy, expecting certainty in forecasts. The problem is, when these predictions don't pan out, they often double down, which only escalates losses. This mindset creates a lot of emotional stress and can lead to an eventual account blowup. Essentially, prediction-based trading ignores the complex and random nature of the markets. On the other hand, professional traders embrace uncertainty. They understand that being wrong is part of the game. So instead of looking for guarantees, they focus on setups with historically favorable odds. They clearly define their risk before entering any trade, which helps limit potential losses. The key is to consistently repeat a proven process across many trades to realize a true trading edge. Tools developed by Bill Williams, like Fractals, the Alligator indicator, and the Awesome and Accelerator oscillators, are used to identify high-probability conditions rather than guaranteed outcomes. This shift from prediction to probability is what forms the foundation of a strong trading mindset. Trading can be incredibly tempting to jump into quickly, especially when you feel the fear of missing out. But the biggest mistake beginners make is trading without a solid plan in place. Instead, I recommend spending your first few weeks simply observing how the market behaves, keeping a detailed journal of your observations, and practicing with paper trading before risking any real money. This approach lays a strong foundation. Keeping a daily trading journal is crucial, not just tracking your trades, but also noting your emotional state at every step. Whether you're feeling anxious, excited, or impatient, understanding these feelings helps you recognize your unique emotional triggers and avoid repeating mistakes driven by emotion. Another important mindset shift is moving away from speculative thinking. Instead of guessing things like, "I think NIFTY will rise today," focus on following clear, rule-based criteria such as entering trades only when specific technical indicators align. This disciplined approach helps you avoid impulsive decisions and builds consistency over time. Remember, the key is to slow down in the beginning to speed up your learning and success later on. Developing emotional awareness and building a reliable process will serve you far better than trying to predict every move the market will make. A fractal is a specific pattern used in technical analysis to identify potential turning points in the market. Starting with the bullish fractal, this occurs when the middle bar in a sequence of 5 bars has the highest high, flanked on both sides by 2 lower highs. This pattern signals a potential breakout to the upside. When the price breaks above this highest point, it triggers a buy signal, indicating that the market may move higher. The signal becomes even more reliable when confirmed by the Alligator indicator and the Awesome oscillator. On the other hand, the bearish fractal is the opposite. Here, the middle bar has the lowest low among 5 bars and is flanked by 2 higher lows on each side. This pattern suggests a potential downward breakout. If the price breaks below this lowest point, it triggers a sell signal, implying that the market might decline. Just like with the bullish fractal, confirmation from the Alligator and Awesome oscillator adds strength to the sell signal. Understanding these fractal patterns helps traders identify key breakout and breakdown levels, improving their entry and exit strategies. This concept is fundamental in technical analysis and can significantly enhance decision-making in trading. When we talk about trend in trading, we're really discussing the most influential force behind price movements in the market. Following the trend means you're aligning your trades with the highest probability of success. Bill Williams emphasized that correctly identifying the trend is the essential first step before applying any trading indicator. We can think about trends on different time frames. The primary or macro trend appears on weekly or monthly charts and is largely driven by institutional money flows. Then we have the secondary trend, visible on daily or 4-hour charts, which represents smaller corrections within the broader primary trend. To assess trend strength, we look at the alligator indicator. When its lines fan out, it signals a strong and well-established trend. The awesome oscillator running above zero confirms that bullish momentum is dominant. For an uptrend, we expect to see a pattern of higher highs and higher lows, while the opposite applies to downtrends. Additionally, the steeper the angles of those alligator lines, the more powerful and sustained the momentum tends to be. Understanding and identifying these elements can greatly improve your trading decisions by keeping you aligned with the market's main direction. Here, we take a closer look at the alligator indicator, which acts like a compass for the market. First, we have the jaw, represented by the blue line. This is a 13-period smoothed-moving average shifted 8 bars forward, and it serves as the slowest and longest-term trend backbone. Think of it as the alligator's jaw, providing a stable reference point for the bigger picture in market movement. Next is the teeth, shown by the red line. This is an 8-period smoothed-moving average shifted 5 bars forward, moving at a medium pace. It reflects the intermediate trend and is comparable to the alligator's teeth. This line helps us understand more recent price actions and when trends might be shifting. Lastly, there's the lips, the green line, which is the fastest of the three. It's a 5-period smoothed-moving average shifted 3 bars forward, reacting quickly to price changes. This is like the alligator's lips, giving us the earliest signals that the market is about to move and potentially start a new trend. Together, these 3 lines work in harmony to give us a clear sense of market direction and timing, making the alligator indicator a valuable tool for traders. Here we discuss the market phase known as the awakening alligator, signaling that a significant move is about to happen. The key indicator is when the lips, shown in green, cross above or below the teeth in red and the jaw in blue. This crossover, combined with the awesome oscillator histogram showing several bars trending in the same direction, suggests growing momentum. Additionally, look for a fractal breakout near the edge of the price range, accompanied by rising volume and a close outside that range. To prepare for this move, first identify the recent fractal level. If the breakout is above this level, consider bullish options, like at-the-money calls. For bearish signals, the breakout will be below the fractal. Set alerts on NIFTY at these breakout levels, but don't jump in immediately. Wait for a clear confirmation to avoid getting caught in false signals. A common mistake beginners make is entering too early at the slightest hint of an awakening. This often leads to losses due to false breakouts. Instead, wait for the full separation of the alligator lines and clear momentum confirmation before taking a position. This approach improves your chances of a successful trade and helps manage risks effectively. Here, we're looking at the hunting phase of the alligator indicator, where precision is key. Notice how the alligator lines fan out in a specific order: lips above teeth, teeth above jaw during an uptrend, and the reverse in a downtrend. This alignment signals a strong trend. At the same time, the awesome oscillator, or AO, confirms momentum by staying above zero for bullish moves or below zero for bearish ones. Price action also plays a crucial role. You'll see fractals breaking cleanly, with prices forming higher highs or lower lows, depending on the trend direction. Pullbacks to the lips line should be swift and are excellent entry points, as buyers quickly step in. Speaking of entries, the best approach is buying ATM or one-strike in-the-money options to maximize delta. It's important to enter on slight pullbacks to the lips line instead of chasing breakouts. For risk management, set your stop loss just below the recent fractal low for calls, or above the fractal high for puts. Your profit target is the next fractal level, which often acts as a natural resistance or support. Always confirm key signals before entering. Make sure the alligator lines are aligned properly, AO momentum is strong, and fractals confirm the move. Be patient and wait for pullbacks to the lips line, keeping your stops tight based on fractals. Also, monitor volume and momentum closely. Any signs of trend weakening mean it's time to adjust your position or exit to protect profits. This disciplined approach allows you to strike with precision, capturing strong trends while managing your risk effectively. The Awesome Oscillator, or AO, is a technical indicator used to measure market momentum by comparing short-term and long-term market trends. Specifically, it calculates the difference between the 5-period and 34-period simple moving averages of the bar midpoints, which we get by averaging the high and low prices. This difference is then displayed as a histogram, where green bars represent rising values and red bars represent falling values. When the bars are above zero, it signals bullish momentum, meaning buyers are in control. Conversely, bars below zero indicate bearish momentum or selling pressure. We pay close attention to patterns in these bars. Consecutive green bars suggest that upward momentum is accelerating, while consecutive red bars signal accelerating downward momentum. One important bullish signal to watch for is called the saucer setup. It happens when we see 3 consecutive bars above zero with a red, then green pattern. The key detail here is that the middle bar should be lower than the first, followed by a green bar that's higher, which points to a momentum reversal in the market. Traders often use the AO not just on its own, but in combination with other Williams indicators like the Alligator and Fractals. This combination helps in timing entry and exit points more effectively, especially when trading options on major indices like NIFTY and SENSEX. Overall, the AO is a valuable tool to confirm both trend strength and momentum shifts, making it a practical choice for enhancing trading decisions. Let's talk about how to use the Awesome Oscillator, or AO, in Nifty options trading. First, when the AO crosses above zero from below, it indicates bulls are gaining momentum. In this scenario, it's a good idea to consider call options, but only when the Alligator indicator confirms this bullish trend. Conversely, when the AO crosses below zero, it signals bearish dominance, and you might want to look at put options. This zero-line crossover is a reliable setup for intraday trading on Nifty charts. Next, on the 15-minute charts, watch out for the saucer pattern. This occurs when momentum pauses and then reverses above zero across 3 bars. If the price is above the Alligator and there's a recent bullish fractal breakout, that's a strong entry signal for at-the-money call options. The target here is usually between 30 to 50 points, with a stop-loss placed just below the fractal low to manage risk. Finally, during sharp intraday reversals near key support levels, pay attention to the twin peak divergence on the AO below zero. This pattern shows 2 troughs, with the second one being shallower, followed by a green bar indicating a momentum shift. This is an excellent signal to either exit put positions or enter calls. These 3 patterns, the zero-line crossover, the saucer setup, and twin peaks, form the core of a strategic approach to trading Nifty options using AO, enhancing your decision-making on intraday moves. Here we're focusing on the Accelerator Oscillator, or AC, which is a tool designed to help us catch momentum shifts as early as possible. The AC is calculated by taking the Awesome Oscillator, or AO, and subtracting a 5-period simple moving average of the AO. Essentially, it measures whether momentum is speeding up or slowing down in the market. When you see green bars on the AC, that indicates bullish acceleration, meaning momentum is picking up. Conversely, red bars show bearish deceleration, signaling momentum is fading. Now, while the AO tells us the current direction of momentum, the AC adds an important layer by measuring if that momentum is actually gaining or losing strength. This ability to detect changes earlier gives traders a predictive edge, potentially allowing quicker reactions to market moves. The most reliable trading setups happen when both AO and AC agree. So when both are positive or showing green, or both are negative or red. This consensus confirms the momentum trend. However, divergences between the two can serve as warnings that a trend is weakening or about to reverse, providing valuable early alerts. We'll also explore exactly how the AC is calculated, how it differs from the AO, and how to use it effectively in your trading strategy to capitalize on momentum shifts. Now, let's explore the 4 essential market phases every trader needs to understand. First, we have the accumulation phase, where smart money quietly builds positions. During this time, prices move sideways or with mild volatility, and volume may begin to increase subtly. The Alligator indicator remains dormant, indicating a lack of strong trend. Retail traders should avoid aggressive trades here and instead watch for fractal patterns near the range boundaries, which can offer clues for the next move. Next comes the trend expansion phase. This is when the market breaks out and the Alligator indicator wakes up and starts hunting. Both the Awesome Oscillator and Accelerator oscillator gain momentum in one clear direction. Prices move decisively and fractals break cleanly, marking this as an ideal time for option buyers to enter on fractal breakouts when confirmed by the Alligator and AO indicators. Following that, we reach the distribution phase. Here, smart money begins to exit positions near market highs or lows. Momentum starts to weaken, evidenced by divergences in the Awesome Oscillator and failing fractals. The Alligator lines converge, signaling decreased trend strength and the potential for either a reversal or consolidation. Finally, we have the decline phase. After distribution, the market typically declines or corrects with increased volatility. Prices trend downward or sideways, and the Alligator remains converged or inactive. Traders should reduce long exposure and consider defensive measures or short strategies during this time, until signs of accumulation appear again. Understanding these phases helps traders align their strategies with market behavior and improve decision-making. Here, we're focusing on a multiple timeframe analysis specifically tailored for trading Nifty options. The process begins with the daily and weekly charts, where we use the Alligator indicator to identify the primary trend and establish our overall directional bias. This step gives us the big picture and helps set the context for our trades. Next, we move to the 1-hour chart. Here, we confirm that the shorter-term trend aligns with the daily trend by using both the Alligator and the Awesome Oscillator, and we mark important fractal points. This confirmation reduces the risk of false signals and ensures that our trades are in harmony with the broader market momentum. Finally, on the 15-minute chart, we look for fractal breakouts that align with the trends identified on the higher time frames. This timing helps us pinpoint precise entry points with better accuracy. For intraday trading, the 1-hour chart guides the trend, and the 15-minute chart is used for identifying entry points. For positional trades, the daily and weekly charts provide the bigger macro trend, while the 1-hour chart helps in timing entries. This layered approach is vital as it filters out market noise, reduces emotional decision-making, improves risk management, and aligns trades with market momentum, which is especially important given the volatility of Nifty options. Altogether, this top-down framework enables us to see both the big picture and the finer details simultaneously, enhancing trade confidence and effectiveness. When we talk about the psychology of winning traders, it's important to understand that the market rewards discipline above all else. Successful traders don't rely just on intelligence or trying to predict the market's next move. They stick to a clear, rules-based system consistently. Following the process is what truly separates winners from losers. Profitability isn't about hitting big wins all the time. It emerges over many trades. Even the best setups don't work every single time. About 40% of them fail. The key is to take every valid setup without hesitation and always apply consistent risk management. This steady approach builds long-term success. Successful traders also develop strong habits. They start their day by reviewing charts before the market opens, avoid impulsive decisions, and set entry and exit rules in advance. Importantly, they keep a journal of their emotions and trade outcomes, which helps them build self-awareness and maintain discipline. To sum up, discipline beats intelligence. Consistency is the real edge, and adopting the right habits makes all the difference in trader psychology. When it comes to trading, fear and greed are often our biggest adversaries. Let's start with fear. Fear of loss can make us exit trades too early, cutting profits short before we reach our targets. Then there's the fear of missing out, or FOMO, which tempts us to chase breakouts late, leading to poor risk-reward decisions. After a loss, fear can cause hesitation, stopping us from taking valid opportunities even though every trade should be judged independently. To overcome this, it's crucial to accept losses as part of the trading cost and to limit risk to just 1 or 2% of our capital on each trade. Having well-defined trading rules helps keep our decisions systematic and emotion-free. Now, greed can be just as damaging. Holding on to positions too long, hoping for bigger profits, can quickly turn gains into losses. Oversizing trades because we think we have a perfect setup increases risk dramatically and can lead to significant losses. Greed also makes us ignore stop losses and risk more than planned, threatening our capital. The best way to manage greed is through disciplined exits and sticking to proper position sizes. It's essential to respect the limits set by your trading plan and avoid letting emotions push you beyond them. Maintaining control over fear and greed is key to successful trading psychology. Risk management is truly the foundation of long-term survival in trading. First and foremost, never risk more than 1 to 2% of your total capital on a single trade. This helps protect your overall portfolio from significant losses. It's crucial to define your stop loss before you even enter a trade. For calls, this is usually set at fractal lows, and for puts at fractal highs. Always remember, preserving your capital is key because if you lose 50%, you then need a 100% gain just to break even. Next, focus on targeting a minimum risk to reward ratio of 1 to 2, but ideally you want a 1 to 3 ratio or better, especially when trading nifty options. It's important to avoid trades where the profit potential is less than twice the amount you're risking. Even with a 40% win rate, maintaining a 1 to 3 risk to reward ratio can lead to consistent long-term profits. When it comes to placing your stops, set them at solid technical levels like fractal lows or highs. Always place your stops before entering the trade, and importantly, never move them once they're set. Proper stop-loss strategies are essential because they limit your losses, protect your capital, and help ensure you survive through losing streaks. These golden rules of risk, focusing on disciplined risk to reward ratios and well-defined stop-loss strategies, are what sustain successful trading over time. When it comes to position sizing, the key is to manage how much you risk on each trade carefully. First and foremost, never put your entire capital into a single trade. That can lead to devastating losses. Instead, follow the 1 to 2% risk rule. This means you should only risk between 1 and 2% of your total capital per trade. For example, if you have Indian rupee 1,000,000, your maximum risk per trade should be between 1,000 Indian rupees and 2,000 Indian rupees. Let's consider a practical example. Say you buy a nifty option at an 80 Indian rupees premium, setting a stop loss at 55 Indian rupees. The risk per lot here is 1,875 Indian rupees, which fits within the 1 to 2% guideline for that capital size. Another important strategy is to scale into positions gradually. Rather than entering the full position at once, start with about half and add more once the trade confirms direction. For beginners, it's wise to allocate around 20 to 25% of your total savings as active trading capital. From this pool, apply the same 1 to 2% risk per trade rule. Also, be cautious with leverage, especially in options where volatility is high. It can quickly amplify both gains and losses. The goal here is consistent risk management rather than chasing big wins. By carefully controlling your exposure on every trade, you increase your chances of long-term success and protect your capital for many opportunities ahead. Let's look at how to buy options using chaos theory. The key entry point is during the alligator indicator's hunting phase, where its lines spread apart indicating a strong trend. For calls, the price should stay above all the alligator lines, and for puts, it should be below. Confirm this setup with a fractal breakout in the direction of the trend. Also, check that the awesome Oscillator and Accelerator oscillator display 2 to 3 momentum bars, signaling momentum support. It's important that multiple timeframes align to increase the trade's reliability. When selecting strikes for nifty calls, opt for at-the-money or one strike-in-the-money options. These offer the best balance of delta and premium gains, while deep out-of-the-money options should be avoided because they suffer from high theta decay. Timing is crucial too. Avoid trading during the first 15 to 30 minutes after market open as volatility can be unpredictable. The most favorable trading windows are from 10 to 11:30 a.m. and 1:30 to 2:30 p.m. For short-term trades lasting 1 to 2 days, weekly options are preferable. Make sure trend alignment is consistent across daily, hourly, and 15-minute charts before entering a trade. Use fractal breakouts confirmed by alligator and momentum indicators like AO and AC as your signals to enter. Avoid chasing moves that lack confirmation, and always set a stop loss at the recent fractal low for calls or fractal high for puts. Above all, patience and discipline are key to successfully executing this option strategy based on chaos theory. When it comes to common beginner mistakes, there are a few key areas to watch out for. First, revenge trading is a major pitfall. After a loss, jumping back in with larger positions often leads to even bigger losses. A good strategy here is to take a 30-minute break to reset mentally before making your next move. Overtrading is another frequent issue. Taking on too many trades in a day can cloud your judgment, so it's wise to limit yourself to about 3 trades per day. Relying on trading tips without verification can be risky. Always trust your own analysis rather than unproven advice. And never ignore your stop losses. Moving or removing them can quickly turn a manageable loss into a disaster. On the technical side, trading fractals without confirming with the alligator indicator can produce false signals, so always look for that confirmation. Ignoring the overall trend is another common mistake that increases your risk unnecessarily. Overusing indicators tends to overwhelm and confuse, so focus on a few core tools. Skipping multi-timeframe analysis reduces the quality of your trades, so make it a habit to check different timeframes for a clearer picture. To avoid these errors, stick to a strict trading plan and routine. Use your core indicators consistently to maintain clarity, and keep a trading journal to track your emotions and mistakes. Always define your stop loss and position size before entering a trade, and practice patience. Wait for the right setups rather than rushing in. This disciplined approach can greatly improve your trading success. Let's walk through a typical beginner's daily trading routine. First, in the pre-market preparation, I start by reviewing the daily and 1-hour NIFTY charts. This helps me identify the alligator phase and key fractals, which are crucial for understanding market structure. I also check global cues and relevant news to get a sense of the broader market sentiment. Based on all this, I set a clear trade plan with precise entry rules. When the market opens, it's important to observe price action closely around those fractals and the alligator lines. However, I avoid trading right away during the initial volatility. Instead, I let the market settle before making any moves, ensuring I don't get caught in unpredictable swings. During the prime trading window, I focus on executing trades only when setups meet all my criteria, including signals from the alligator, fractals, AO, AC indicators, and the right time frame. Discipline is key here. I stick to my position sizing and entry rules without deviation. Around midday, I review my trades and check in on my emotional state, which is essential for staying objective. If necessary, I adjust stop losses to protect capital. This pause also serves as a mental reset before heading into the afternoon session. In the afternoon and towards the market close, I look for secondary trade setups that align with the overall trend, but consciously avoid chasing trades out of desperation. I make sure to manage these trades with discipline and close positions responsibly before the market shuts down for the day. By following this routine, it becomes easier to maintain consistency and improve trading outcomes while managing risks effectively. Here, we have a complete walkthrough of a NIFTY options trade using Bill Williams' full trading system. On Thursday morning, the NIFTY was clearly in an uptrend on the daily chart, confirmed by the alligator indicator with the lips above the teeth and the teeth above the jaw. The awesome oscillator was also positive, indicating strong momentum. On the 15-minute chart, after a 45-minute consolidation around the teeth following a pullback, a bullish fractal formed at 22,350, marking a key resistance level. At 10:15 a.m., NIFTY broke above this fractal high with a strong bullish candle. The momentum indicators aligned perfectly. The AO showed 3 consecutive green bars, the Accelerator oscillator had 2 green bars, and the alligator was fully hunting. This setup gave a clear entry signal to buy the NIFTY 22,350 call option at 85 Indian rupees. To manage risk, we set a stop loss just below the fractal low at 22,270, risking 2,250 Indian rupees per lot. The trade reached its target at the next fractal resistance of 22,500, yielding approximately 150 Indian rupees in option premium profit. This case clearly demonstrates how combining trend analysis, momentum, and fractal confirmation using Bill Williams indicators increases trade confidence, ensures disciplined entry, and effectively manages risk. It's a great example of disciplined, high-probability trading. As we wrap up, let's focus on some key lessons from trading chaos. First, the market rewards discipline, not brilliance. It's essential to trust in the system you've developed rather than relying on your ego. Keeping things simple is crucial. Use the 5 core indicators, recognize the 3 market phases, and follow one clear rule consistently. Remember, trading starts with yourself. Managing your emotions and mindset is actually more important than market conditions. Think of trading as a journey that involves ongoing learning, embracing failures, reflecting on them, and continually improving. Now, a note of responsibility. This presentation is intended for educational purposes and is not financial advice. Always conduct your own research before making any trades. To deepen your understanding, I encourage you to study Bill Williams' original works. Before you start trading real money in NIFTY and SENSEX options, practice extensively with paper trading. Finally, success in trading comes from disciplined and consistent execution, which is how you develop a real trading edge over time. Thank you all for your time and attention. If you have any questions or would like to discuss further, please feel free to reach out to me on Telegram at +91 88004 57415. I appreciate your interest and look forward to connecting with you. This presentation is proprietary to Precision Capital Academy LLP. Thanks again.